Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And in the last couple of videos where I talk about the truth about living off high yield funds, the truth about covered calls, plus the follow-up video, I asked you if you would like a video for me to specifically discuss the funds or the high yield funds that you could actually that are ideal rather to live off of. So it's very important that we understand when I say live off of right now in this video, the context is that you're pulling out all the dividends, all the distributions every single month from these funds or from your account to live off of, right? So that's what I mean by live off of, or that's what we're going to be discussing in this video. So very important to understand that. So many of you have said, yes, I've gotten many comments. Yes, please, Adrian, make a video on the funds you think are ideal. So you asked for it and you got it, guys. I'm here to give you what you want. So we're going to be, again, just talking about high yield funds, which I feel, this is my opinion, guys. I repeat, this is my opinion. The funds that are ideal to live off the distributions where you could pull everything out. So it's mostly going to be, diversified or broad index based funds here, guys, right? It's very convenient, or it makes more sense to me to live off something or funds that are diversified, that are either index based or that are diversified. So there's not going to be anything sector specific here, with maybe a couple of exceptions in the fixed income world. But I just want you to understand that it doesn't mean you cannot live off sector specific funds. It's just not as ideal. Remember, keyword is the ideal funds. So if you have, for example, no diversified funds and you have 10 sector specific funds, but altogether you're diversified, that could work. So again, it's not that you can't do it with sector specific funds, but I'm just trying to give you the most ideal funds. Same thing for QQQY, JEPY, YMAX that just came out, just declared the first distribution, 30% yield on YMAX. It's not that you can't do it, but it's just, in my opinion, not ideal, not feasible to pull out all the income from these funds and live off of, because the capital in your account is going to go down because you're pulling a lot of your investment out. So again, not that you can't do it, but in my opinion, you would need to reinvest some of it if you're going to do it off these really high yield funds. But already discussed that to death in the previous video. So let's get to it. We'll cover the American US stock market first, and then we'll do the Canadian one this time. So if you're Canadian, I suggest you watch both. But if you're American, you don't have to watch the Canadian part. So let's get to it, guys. My opinion on the funds that are ideal to live off of forever. All right, guys. So on the US market, my opinion, and even in the covered call options world, the most common fund is the index-based funds. And of course, you have the S&P 500, which is the king, and the NASDAQ 100 as well, which, by the way, if you think about it, right, everything in the NASDAQ 100 is going to be in the S&P 500, but the NASDAQ is just more technology focused and has no financials. But those are really the funds that we're going to take a look at. And plus, I think 90% of the funds are basic, income-oriented funds, are some sort of S&P 500 or NASDAQ 100 style. So in the US, you have plenty of S&P 500. Some are not exactly the S&P 500, guys. Some are stock picking stocks from the S&P 500, right? So you got 7 of them when it comes to the S&P 500. And in my opinion, this can not only be your only position if you want a combination of these or one or two of these, but it should be the biggest position in your portfolio because it's super broad based. Just my opinion again. And we'll go with the lowest yielding, lowest risk ones to the highest yielding, highest risk ones. And when I mean risk, very important, I'm not talking about the actual risk of the fund. I'm talking about the risk of your capital, of your account staying stable if you're pulling everything out, right? And of course, guys, it's not rocket science, right? I mean, come on, it's not rocket science. I saw Average Joe just made a video on top funds where your capital gets the most preserved if you're living off of things. I mean, I could, without even looking at the video, of course, the ones with the lowest yields are going to fare best, or your capital is going to be the highest after X amount of years because there's less yield, more of, it's just how the fund works. So of course, if you have an S&P 500 that has options or income ETF that has 5% yield, you'll have more capital if you're pulling it all out after 5-10 years than one that has 6% or 7%, et cetera, right? So let's not break our head. Let's not lose our stuff here, lose our mind. So all of these I feel are good to live off of course. And of course, the lower the yield is, the less you're going to make every month, but the more capital or the higher the capital is going to be in your account. So it's up to you to choose and figure out what is most ideal for you. So Devo, let's start with the lowest yield ones. You got Devo, which is not exactly the S&P 500, but it's a stock picking S&P 500, very, very low yield of only 4.83. So this is, for me, is a boring one. But Devo is definitely a great option or an ideal fund to live off of course. You have PAPI, which seems to me a copy or very, very similar to Devo. I haven't done a video on this yet. This is very, very, very brand new from Morgan Stanley, but it looks identical to Devo to me, or very, very similar. That's going to be one of them as well. Another new one that just came out and I feel is really, they're trying to compete with JPI from JP Morgan, is Bali from iShares. This looks like almost a JPI clone to me. Even has the same expense ratio, guys. So now we're going up in yield a bit. We're talking more the 6, 7, 8% range. Of course, now it's a bit lower because the VIX is really low. Remember, a lot of these yields are going to be based on volatility. If volatility is low like it is now, the yields are going to be lower, but it's up to you. Remember to always look at the history of the fund, of the distribution, to get an accurate description or an accurate assessment of how much yield you're going to get. But Devo and PAPI are probably going to be in the 4 or 5% lower range. When it comes to Bali and JEPI, which is the undisputed king or the biggest covered call ETF in the US, you're looking at yields, depends, could be anywhere. JEPI is usually 7, 8% yield. Right now it is a little bit lower. So Devo, PAPI, very, very boring. But the more boring means the less income, which means there's more capital preservation. Bali and JEPI, I would say slightly not as boring, but still very boring. Also GPIX, this is another new S&P 500 covered call ETF from Goldman Sachs. This is actually the first pure S&P 500. It really is the whole S&P 500. And I believe the yield, you're looking at something very similar to JEPI, maybe a little bit higher. So maybe 9%, something like that for a GPIX. Very reliable, right? Goldman Sachs, relatively new ETF. What I like about it is that it's actually the entire S&P 500 instead of these guys, all these guys which do stock picking. It's on the S&P 500. It's not the entire thing. I would always prefer the S&P 500. That's just my personal opinion. And the next three are literally the S&P 500 and what I feel would be my favorite because they're higher yield. It would be SPY. Very nice, consistent, approximate 12% yield. I really love what these guys have done with this strategy. You're looking at about 1% yield a month. This is the pure S&P 500, just like GPIX. And another one, which is very, very interesting, brand new from ProShares, is ISPY. This is S&P 500 with daily options. So this is a JEPY competitor. And I thought, the yield's probably going to be 20, 25%. I was assuming less than JEPY. But it looks like these calls are out of the money and the yield is about 14, guys. So I think this one is definitely a great potential to live off of. Very nice low management fee, much less than JPY. But I would have to say SPY and ISPY, probably my favorites, except it's not proven ISPY, so we don't have a really good sense. But definitely got to keep this one on your radar. So these are the S&P 500 ones, my opinion, you could live off of. Obviously, I'm a yield investor. I'm more of an high income investor myself. So for me, SPY is a fantastic option. ISPY could be a great option as well with daily calls. We'll have to wait and see. I think the MER is really impressive at 55, even less than SPY, by the way, which is rare because when you're doing daily options, a lot more work. So, and if you're more conservative, you have the first 5, and of course the lower we go, guys, the less yield you get, and the more, of course, your capital is going to be preserved because less is coming out from your investment. It's not rocket science. So that's S&P 500. Moving on to the NASDAQ 100, which is a fantastic index as well. You have JEPQ, of course, and NASDAQ is more volatile, so you get a little bit more income than the S&P 500 ones. So we have JEPQ from JP Morgan, of course. We have GPIC from Goldman Sachs. And again, GPIC is the entire NASDAQ, where the JEPQ is not exactly the entire NASDAQ. And now you have SPY's twin brother, sister, QQQI. This is going to be a great option. I have a feeling that the yield's probably going to be around 13.5, maybe 14%. Got to be higher than SPY, right? Because the volatility is higher. So I expect something like 13%. Hopefully, as far as I could see, the strategy looks exactly the same as SPY, but they're doing it on the NASDAQ. So I think out of these three, for sure, my preferred is going to be QQQI. And hey, maybe ProShares. I don't see why not, we'll launch a NASDAQ version of this, which could probably have 15, 16% yield, which kind of goes over my magic 15% target, but it could still be ideal to live off of technically. So these ETFs, guys, that I've reviewed, these are the S&P 500, NASDAQ 100 options or covered call ETFs. I feel are great options because you're investing in the index. So it's very safe to do so. And if I was building a portfolio as an American to live off of, a combination of S&P 500 and NASDAQ would be the majority of my portfolio. And it could be all of your portfolio. You'll never, ever have a problem. If you want to add some alternatives or fixed income, my favorite by far is going to be SVOL. SVOL is the undisputed king. Not only is it outperforming everything, it's also outperforming the S&P 500 index. It's beating VOO, if you could believe it, guys. It's just an absolute phenomenal ETF. It's a phenom. Fantastic 15% plus yield. This I would definitely make a 20, if you know, at least a 20%, 15-20% position in my portfolio. It's proven itself. Maybe some of you are not comfortable. It's a little bit complicated to understand, but I strongly suggest you view the last Q&A I did with Shailesh. The ETF has become even less risky now. So I absolutely love SVOL, my favorite alternative style ETF. If you want something lower risk, you have high and THTA now. Very safe, stable stock price, a 9 to 10% yield. This could be a great lower risk alternative to SVOL, but I love SVOL. So, you could add these to maybe your core equity positions with all the S&P 500 NASDAQ we saw. The percentage is up to you if you're building a portfolio, but my opinion, I feel like, the S&P 500 NASDAQ exposure should be at least 60, 70, 80% of your portfolio, and the rest could maybe be in some alternative stuff like SVOL, like high, like THTA. And if you want some fixed income stuff, I feel like if you really want some fixed income exposure, AGGH is probably a great option from Simplified because it's a mix of, it's diversified within the fixed income or bond market. And I know there's TLTW and LQDW and HYGW, but I have to admit, it's hard to say if these are ideal to live off of. The cover calls are very aggressive, and the yields they vary greatly. They could be anywhere from 12 to 18% yield. If you really want bonds in your portfolio, guys, for some reason, this is AGGH, TLT, and the rest. This would be my least favorite category. I feel like you don't even need them, but if you really want, AGGH to me is probably the best option because it's diversified within, but I would always pick an SVOL over anything when it comes to alternatives. So that's pretty much, and I'm sure there's more of them, guys. Notice, I didn't put QYLD, XYLD, RYLD, the G's in there. Those you can live off of as well, because the D's reinvest half of the premium in the fund. So I guess you can pull it out. But like I discussed in a previous video, I think that those option strategies are outdated. And I would much rather you go with these ones instead of the XYLD, and one of these three instead of the QYLD. Of course, I discussed that in a previous video. If you just do search my thumbnails, you'll see QYLD versus JETQ, and I explain it there. So those are also, I guess, you could live off of, but I feel that these ETFs are much better. That's it for the US market, guys. Is there any of them that I've missed? Remember, SCHD is not going to be here because that's not an option. There's no options there. It's just a pure dividend ETF. Those, of course, you can live off those, but you probably need a few $1 million if you're making 3% yield, right? So let's move on to the Canadian market. So when it comes to the Canadian market, guys, we are absolutely spoiled for choice. Many, if not all of them, are ones you could live off of. Okay, guys, it's very simple. Again, these are only going to be the diversified ones. You can do it with sector specific. I feel it's not ideal. It's more ideal if you're living off of something to make sure they're diversified. So you have leveraged options and non-leveraged options. Of course, should know all of these by heart. I feel these are all great, and you could live off of these. And remember, guys, again, the higher the yield is, typically the higher the yield is, the more cover calls they're doing, which means the more income you get, the less upside potential you capture. So I feel the magical range is between 10 and 15, but there's some that are in the 8, 9, like the more conservative ones. Of course, that's more if you're a conservative investor and your capital is going to be preserved most likely more because you're just getting less income, right? It's not rocket science. So let's go through them really quickly. Of course, you have HYLD, HDIV, HDIF, BMAX, guys. They're all diversified. USCL, which is literally S&P 500, QQCL, NASDAQ 100, CNCL, TSX 60, all of Canada, and now you even have EQCL, which is a combination of all the Horizons covered call ETFs with some emerging market and international developed growth style. So all of these, and I will include EIT. I know the title says ETFs, or maybe it doesn't say ETFs, whatever. EIT is, of course, it's one you could live off of, guys. Come on. It's undisputed king. It's greatly diversified, and it's also diversified with region. Now you see here, it's half Canada, half US approximately. Very, very well diversified. So these are all leveraged a little bit. EIT 20%, everything else 25%, except BMAX is 33%, but BMAX has more conservative holdings, so that kind of nullifies that risk. In my opinion, I would always go for the diversified leveraged ones. Those are my favorites. So any one of these. And of course, you have the non-leveraged versions for USCL, QQCL, CNCL, and EQCL. It would be USCC, QQCC, CNCC, GRCC. These are the non-leveraged versions. My opinion, I would always, if you're just going to buy something, hold it long term, live off the income, you might as well have that leverage. But in case you're not comfortable with it, you also have non-leveraged versions for all the Horizons ones, and you also have a non-leveraged version for HDIF, which is HRIF. Just click on without leverage, and you will be directed to HRIF, which is just HDIF without the leverage. So, my opinion, these are some of the best ones. Leveraged, I would always take a leveraged one. If you don't want leveraged, BMO has a great one, ZWQT. This is an all-in-one BMO one, guys. All the BMO covered call ETFs, and even within ZWQT, you could even hold. They have ZWC for Canada, ZWH for US, ZWG for global. So if for some reason you don't like ZWQT, you want to go with the C and the H for the C for Canada, H for US. I would say my favorite one, or the one that makes the most sense, the most ideal, would be ZWG, right? Because it's global, it's more diversified. You have ESPX, which is the S&P 500 from Evolve. No leverage with covered calls, so very, very similar to USCC, but a bit less covered calls. They only do covered calls on 33. So this is going to give you more capital upside or appreciation on the S&P 500 than USCC. But you're going to have lower yield, of course. USCC is about a 10.5% yield. Of course, if you're writing less covered calls, you're going to make less yield. Here's another great option because it's literally the S&P 500, and now you have the ETSX as well, which is the entire Canadian market. Same thing as CNCC, but again, with less covered calls, so you're going to get probably less yield. But it's actually, the yield is pretty high here, 10%. So these would be my top ones. They're all mostly equity. Yes, HDIF, HYLD has the bonds, some government bonds in there, but it's very, very, very small, very, very little. And that's going to be your main equity ones. I feel you can live off all of these, no problem. Which ones you choose, which combination you do, it's up to you. If you're more conservative, if you want more capital preservation, if you want more upside, obviously you're going to go with the ones that do less covered calls. And hence is why I keep repeating, you got to understand the fund that you're investing in, guys. I'll never stop saying that. If you want to add some fixed income, you have HPYT, you have HBond, you have LPay. These are all long-term government bonds, so you can get really nice yields here. HAPPY-T is the highest yielding one at over 15%. HBond's a little bit near 10, and LPay's a little bit near 10. And notice that I've excluded split share fund Class A shares here because, as you know, split share funds, I wouldn't say they're the most ideal because sometimes if the unit NAV goes under 15, just the way they're designed, you don't get the dividend. So if you're living off of something, obviously you want to make sure that you're getting paid every month. So with all these ETFs, they're not split funds. I would say they will pay you every month. It could vary, however, but unlike split funds, either you get it or you don't. But it doesn't mean, again, that you cannot live off the split funds. I would say the most ideal one would be GDV. GDV is very, very diversified sector and region. It's never missed a dividend. So if you want a little bit more kick than BMAX, you could go to GDV. GDV is probably the most ideal split fund to live off because it's diversified and it's never missed a dividend. Most of the other, if not all the other split funds are not diversified, they're sector specific and they could miss dividends. Even though Middlefield has RS, ENS, they never miss dividends, but ENS is just Enbridge, RS is just real estate. I guess you could do it with RS, but you know what I'm trying to say, where this video is about the most ideal funds. And in my opinion, it's going to be these ones, the ETFs, covered call ETFs that are diversified or index based. And in my opinion, I would always go with the leveraged version. So and you know, I didn't cover all of them. I'm sure there's other ETFs here. I know like TD, RBC, they have their own covered call ETFs now. And there's other ones, but to me, those boring ones from TD and RBC are very similar to BMO, same type of yield, same type of strategy. And BMO's the OG, I would always go with them. So again, the most conservative, most boring ones are really going to be your BMAX, in my opinion, the BMO one, these ones here, because they only do covered calls on 33% of the portfolio. My personal favorites, I'm obviously a yield guy, I would always go for these ones, the leveraged ones, right? EQCL, also a great, phenomenal, unique option because it has some growth and it has all regional sectors. So I would say EQCL and HDIV are very unique because they both have a little bit of growth in there. You'll get a little bit lower yield, of course, but that's why, because there's some funds in there that are growth funds, not covered call funds. So just wanted to point that out, that these two very unique in that sense. So hopefully this video was informative for you. I'm out of breath, guys. So what are your favorite funds to live off of? Which makes sense for you? Let me know. Do you agree with my assessment? Did I miss any? I'm sure I did. But you know, obviously the theme here is they got to be diversified. Those are the most ideal. So take care. See you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members, where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram, where you could follow us, or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.